British financial services exports have struggled to recover from the twin hits of COVID-19 and Brexit and are lingering at levels last seen in 2006 when adjusted for inflation, new data showed on Thursday. Britain exported £14.5 billion of financial services in the third quarter of last year, according to new inflation-adjusted figures from the Office for National Statistics, the ONS. While up slightly from £14.1 billion in the second quarter, which had been the lowest reading in 15 years, the data pointed to tough times for exporters of financial services. Exports of financial services to the European Union totaled £5.1 billion in the third quarter, just ahead of exports of £4.4 billion to the United States. In 2019, when financial services trade with the EU was still unrestricted, quarterly exports to the EU were around £1 billion higher. Financial services exports to EU are down around 10% compared to non-EU exports since 2019, but at least part of the fall is probably due to COVID-19 rather than Brexit, said Thomas Sampson, Associate Professor from the London School of Economics, and he said that about the data on Twitter. He said the data for services trade overall, excluding travel and tourism hit by the pandemic, suggested Britain's deal with the EU had reduced flows in the first 3 quarters of 2021 overall, although mostly because of lower imports. Financial services, which have been touted by ministers as key to Britain's post-Brexit future, are the country's largest single services export. Other sectors are faring much better. Exports of other business services, which include consultancy, outsourcing, legal advice, and architecture, had almost recovered to peak levels, even adjusting for inflation, at £29.2 billion in the third quarter. Britain's financial services exports hit an inflation-adjusted record high of £21.6 billion in the fourth quarter of 2007, shortly before the financial crisis. The most recent peak, with £17.8 billion in the second quarter of 2016, came just before the vote to leave the EU. Following Brexit, the financial sector has found it harder to trade with the EU, which had been its biggest export customer, and that by a wide margin. But some banking, insurance, and other financial activities undertaken for customers in the EU that had previously been done from London must now be conducted inside the Union, with taxes paid locally. Although surveys show London remains in the top 2 global financial centers with New York, financial sector officials are looking to authorities to help boost the city's global attraction, given that EU financial centers such as Amsterdam present new competition to London. The UK should promote the competitiveness of its financial services industry beyond trade deals in order for UK financial services exports to thrive, said Angus Kenman, Director of International Affairs at UK Finance. And he said, that means delivering on the government's regulatory reform agenda, whilst, of course, maintaining high regulatory standards and a sound legal system, essential also to the industry's success. Regarding Brexit, British Prime Minister Boris Johnson accused the European Union on Wednesday of implementing part of the Brexit agreement covering trade with Northern Ireland in an insane and pettifogging way. And those comments Ireland dismissed as unhelpful. Oh, you Irish, you are so polite. The EU is implementing this in an insane and pettifogging way, and we need to sort it out, Johnson told Parliament, complaining that the so-called Northern Ireland Protocol was stopping some food deliveries and having other difficulties. Irish Foreign Minister Simon Coveney said the comments were unhelpful as the European Union was bidding to build trust with new lead British negotiator, Foreign Secretary Liz Truss, who took over last month from David Frost, who resigned, kind of in protest. Coveney, a key figure in the negotiation of the protocol, told the upper house of the Irish Parliament that he welcomed the constructive atmosphere of recent talks involving Truss and that he hoped progress could be made in the coming weeks. Truss at the weekend said she believed there was a deal to be done on the impasse, which centers on trading arrangements for Northern Ireland. The number of shuttered shops in Britain edged lower for the first time in 4 years in the final quarter of 2021, providing a glimmer of hope for the country's beleaguered shopping destinations, according to data published on Friday. And so I wanted to bring something positive into the video as well. A joint report from the British Retail Consortium and the local data company said Britain's shop vacancy rate was 14.4% in the fourth quarter of 2021, 0.1 percentage points below the third quarter level. The rate was, however, 0.7 percentage points higher than the same point in 2020. With the bricks and mortar retail sector hit hard by the COVID-19 pandemic, 1 in 7 shops remain vacant. The BRC LDC vacancy monitor found high street vacancies fell slightly to 14.4% quarter on quarter. Shopping center vacancies dropped 0.3 percentage points to 19.1%, and retail park vacancies remained at 11.3%. The report noted the lowest vacancy rates were seen in the south of England, where higher disposable income and greater business investment meant vacant storefronts were more quickly repurposed. Scotland and the north of England continue to see much higher vacancy rates, with almost 1 in 5 shops closed in the northeast of England. This is the first real indication that the most significant structural impacts of the pandemic are potentially at their peak for certain regions, said LDC Director Lucy Stainton. She highlighted that growth in the number of independent businesses was partially offsetting ongoing closure across many retail chains and leisure operators. And Helen Dickinson, the CEO of the BRC, said that with hybrid working unlikely to disappear anytime soon, it will be difficult for vacancy rates to fully recover. British retailers reported a better January for sales than this time last year, though, when COVID-19 lockdowns kept shoppers at home. But they still judged it as a disappointing rebound, a survey showed on Thursday. A net balance of plus 28% of retailers reported an increase in sales this month compared with January 2021, the Confederation of British Industry said, and this is up from 8% in December. But almost a third of retailers said sales turned out poorly for the time of the year, compared with fewer than a tenth who said they were strong. With a net balance of minus 23%, it marked the worst reading for sales judged by seasonal standards since March 2021, when non-essential shops were closed due to lockdown. It was not surprising that retail sales dropped back below seasonal norms in January, given the spread of Omicron, the reintroduction of restrictions late last year, and increased consumer caution, said Ben Jones, lead economist at the CBI. Other data published on Thursday painted a more upbeat picture of the economy at the start of 2021. Credit and debit card purchases, as measured by the Bank of England's CHAPS interbank payment system, rose to 87% of their February 2020 level in the week to January 20th, up from 85% the week before. Although this does not adjust for seasonal variation. Jones said retailers would be approaching the rest of 2022 with caution. The sector faces an inflation double whammy as rising energy and transport costs erode household spending power and retailers' own costs continue to mount. Annual consumer price inflation hit an almost 30-year high of 5.4% in December, and the Bank of England thinks inflation will peak at around 6% in April. The CBI survey was conducted between December 22nd and January 18th and was based on replies from 42 retail chains. British consumer spending on credit and debit cards increased slightly last week as more people went out shopping or to restaurants, according to weekly data that add to signs of a waning economy impact from the Omicron wave of COVID cases. Britain's economy regained its pre-pandemic size for the first time in November, but economists estimate that output slipped back in December and early January, when a wave of COVID cases hit the hospitality sector especially hard. At its peak at the turn of the year, almost 7% of the population in England was infected with COVID-19, but case rates have now fallen to under half their previous level, and guidance to work from home and mask-wearing rules have largely gone. For the past couple of weeks, figures collated by the Office for National Statistics have shown a pickup in early measures of consumer spending and in other economic activity. Credit and debit card purchases, as measured, as I said, by the Bank of England's CHAPS interbank payment system, rose to 87%. And I recently made a video on the question, because of the inflation and the rising prices in the energy sector, with titled, "You have to choose between eating and heating," which is unfortunately too true, or far more true than I would like it. But I obviously do not ignore the comments under my videos, only the trolls. And there were some people who wrote that they are in that situation and they have to make that choice. And because it's not only because of the rising prices that are happening globally, but also a lot that is house-made in the UK. I'm really sorry for you, and I keep my fingers crossed that you will get out of this and there will be a solution that the government and the country will finally find a way and the will to help the people in those situations. So you are not forgotten and your story is heard, and I wish you all the best. And for the rest of you, and you of course as well, I'll see you in my next video. Bis gleich.